We've talked previously about how high inflation, which was a function of the pandemic and the Ukraine war, improved markedly last July, and we've now had 12 months of moderate inflation in the range of 3 to 4%. That's still slightly above the Fed's target of 2%, but well below the 9% peak of last year, and far below the 15% from way back in the 1970s. The only other time in the last 50 years we've had really harmfully high inflation. Our recent improvement came about last July when interest rates were at 2%, underscoring our belief that our current interest rate of 5+% is unnecessary, as is the need for further increases. In China, the world's second largest economy, inflation stands at 0%. In Japan, it is 3.1%. In France, it is 4.4%. In the UK, of course, struggling with the nightmare of Brexit, it still stands at around 8%. But if you voted for Brexit and didn't realize it would hit prices hard, I'm not sure what exactly to tell you. Back to the U.S. The big drop in inflation came last July when interest rates were only 2% and has averaged only 3.1% over the last 12 months. Note this is monthly inflation annualized, which gives you the clearest insight into the most recent trends. So if inflation has now tumbled to 3% and looks poised to go no higher than this 3 to 4% range, why is the Fed keeping rates so high? Presumably it is to bludgeon inflation all the way back to 2%. And furthermore, we believe that the Fed was embarrassed by its inflation commentary in 2021, is now determined not to make that mistake again, perhaps even too much so. But we want to make two important points about the Fed's high interest rates. First, they are a boon to the wealthy and a wound to the middle class. When interest rates rise, number one, higher rates increase the cost to the government. Number two, businesses get hurt through higher interest rates with an inevitable response of either raising prices, reducing expenses, notably payroll, or reducing dividends. Number three, the top 10% of households who are net holders of financial assets. In other words, they have more bonds they own than debt they owe. You see, higher interest expense to the government is interest income to households. Income has to equal expense. Though it is devilishly difficult to get a precise read on this, the top 10% may have benefited by as much as 75 to 100 basis points of GDP over the last year on net interest costs alone. Number four, the bottom 90% of households who have far more debt than financial assets may have been hurt by as much as 25 to 50 basis points of GDP, though again that number is only a rough estimate. Number five, to add insult to injury, the rest of the world is a net holder of U.S. debt, so it receives higher interest income from the government on those assets and is thus a significant net beneficiary too. So, the wealthiest profit, the middle class gets hit, businesses get hit, and may raise prices in response, further hurting the middle class, and the rest of the world does pretty well at our expense. The second point we want to make about the Fed's high interest rates are that high interest rates themselves may be the culprit for some component of high inflation. Inflation is a measure of rising prices, and high interest rates make things more expensive. In fact, housing costs alone, referred to as shelter costs, are weighted at 35% of CPI, and high mortgage rates cannot be helping those costs. Add to that the fact that some businesses raise prices as a response to their own higher interest costs, and that further hurts inflation. So, we think it's time for the Fed to stop raising interest rates, and may even be time for it to start reducing them. That's it for this week. Thanks.